Welcome, ladies and gentlemen. FOMC. Yes, FOMC. Well, what can we expect from it? Powell to cough a couple of times, you know? A few good questions from our lady Gina. You know, I'm looking forward to seeing her. Yeah, I know you guys are looking out for her. But this is the moment of truth. Word on the street is they're expected to hold the interest rates because inflation is still a problem. Borrowing costs still going to be high. The restructuring of corporate debt is going to be the bane of Wall Street. The yields still at 5%. The labor market doing great. Biden smashing it. He's making sure that the US is in work. No problems there. NASDAQ and S&P still trading at the lows of the day. Bitcoin at 56,853. Completely wiping the floor with many traders who are just holding on to dear life. You don't pay yourself, you don't pay yourself. Don't be complaining, you know? Now, a lot of people are playing the DCA game right now. I think Bitcoin can be a little bit cheaper. As we said in the live stream earlier on today, there are a couple of zones that you could effectively start preparing to load up. But it all depends on what Powell is going to reveal. What kind of tone are we going into over the next month or so? We've got non-farm payrolls coming out on Friday. Unemployment claims coming out tomorrow. Why did I do that in reverse? Quite frankly, the ADP employment change has pretty much given us the heads up that things are still looking good for the employment market. Again, it's still a problem for the Fed. And what we're going to be looking for today, ladies and gentlemen, is Bitcoin going to make a reversal from the lows? Is the NASDAQ and the S&P going to make the reversal from the lows? I mean, looking at BTC right now, it's not really doing much. So don't get all too pumped about Bitcoin climbing up right now. We ain't got no flavor whatsoever. But hopefully, by the time we're done with this evening, we'll know exactly where we stand. We know that the Fed is going to keep the interest rates on hold. But we got to be listening out for when Powell will suggest the idea of cuts. And we've also got to be keeping an eye out on anyone that asks the question about a soft landing or a hard landing. The ideal scenario would be a soft landing. We want a soft landing. That means when we've increased interest rates, that the impact on the economy isn't so bad, okay? But the hard landing scenario would suggest that if we've increased interest rates that much, then it's going to hurt the economy. Well, I'm not being funny or anything, ladies and gentlemen, but the NASDAQ and the S&P have not stopped going up for quite some time. We're bound to see a little bit of a corrective phase. As I've said before, the US debt market is growing by $1 trillion every 100 days. Like, let's put things into perspective. We need a correction. Oh, Tina, you're so negative. Hey, you know what? Maybe I am. Maybe we need something like this to happen to just reset the whole flavor. Don't shoot the messenger, man. Anyway, do you like the shirt? I thought I wouldn't drop the waistcoat tonight so we can get the full effect of what's going on with this special exosuit shirt, courtesy of Call of Duty. So mad love and respect. That's a joke. I am not endorsed by Call of Duty. It just looks fitting and it's the good stuff for FOMC. All right. So if you are new to today's live stream, make sure you like and subscribe. It's going to be a long one, but we're going to be tuning in to listening to what Powell has to say. We're going to listen to the questions, but if the questions start to die off, I'm not going to be showing any interest in dead communication. We are not going to be speaking about XRP. No, I'm running off with that joke too much, but it's close to my heart. XRP it has that ripple effect. Come on. That stupid coin. Anyways, let's get with the program. So what have we got in front of us? Bitcoin on the left of the chart. I'm going to be arranging the charts very, very shortly, guys, so don't worry. We've got NASDAQ in the middle, and we've got the US 2-year bond yields. This thing right here, anything above 5.04%, if this thing spikes, we've got a problem. And if you're watching the news, okay, and you want to know where money's at, the second this chart on the right shoots up, you know exactly what money's doing. This is an advertisement scheme. This is the government saying, please give me your money. We need it. We'll give you 5%. And I will continuously, I will just remind you every single day the importance of the yields. Some of you might be like, no, don't worry about the yields. We need to just focus on everything about Bitcoin and the on-chain analytics, like the stablecoin ratio, which is consistent. We spoke about this earlier on. So this is for anybody new passing through to tonight's live stream and you missed this morning's live stream. The stablecoin ratio suggests that, with the exception of XRP, which is actually part of the stablecoin environment, but the idea is that as we get lower figures of the stablecoin ratio, which is what it's showing right now, it suggests buying power. Okay, so this could lead to a reversal in Bitcoin, but we've got to be careful of the tricky behavior of what the market maker can do. What market maker are you talking about, Tino? I'm talking about the market maker that provides you the opportunity to do this. What's this? This is a liquidation chart. Why is it important? Because it just shows you where money is at. That's where money is. Right now, we've got high leverage over here, which is represented by the color amber, yellow, gold, beg to differ. Right now, we've got a sad story of short or long liquidations that could be triggered at around the 56,500 zone and even the 55,874 region before they start tapping into the true margins. This is true margin. This is people using small amounts of leverage and putting up quite a bit of margin to open a trade on Bitcoin, okay? And this is very, very important for us. Now, what's the story with this stuff right here? We have got a collective of bids coming into action. And I'm going to change this chart, okay? And we're going to look at it from a higher time frame perspective. Let's go on the 8-hour time frame to understand where we are. Like I said earlier on, they are not selling Bitcoin. The weak hands are selling Bitcoin. Look at what's going on. They are loading the dear life out of Bitcoin. Like literally loading up. They ain't stopping. Well, I hope they do stop at some point. But tonight could be a trigger to effectively see the offers coming into play. What does that mean? As they are buying and price is going down, there's going to come an instance when traders are going to get effectively trapped. Okay? So if you look here, we zoom in a little bit more, you can see that we're starting to see some offers coming in, and they were offering out at 57,000, 5.13 million, got filled. And you can see over here that they did try and get some more offers. So it's quite short term in terms of how long they're taking to sell the Bitcoin. Okay. So when they drop prices down, they instantly reverse it back up to try and take some profit on getting a lower fill on Bitcoin. So they're buying it as cheaply as possible within the given range, and then they're reversing it back up. Again, this is short-term trading behavior. It's like they're not leaving the exposure for long. Now, some of you might say, hold on a second, Tino. What about these guys over here? Well, these guys over here, what we don't know is we don't know if these guys over here have already made their profits and they're restarting the bidding process. They're restarting their DCA. So we then go into the chart of Bitcoin and go to the higher time frames. And then we say to ourselves, all right, then, how likely is that going to be the case that they are starting anew? Well, they started anew back when Bitcoin hit its all-time high. So let's just go back to Bitcoin's all-time high. Look at that. They started from here. They came down and they just rocked price to the downside. And before you know it, they came back and recovered the whole shebang. It did take a little while, but nonetheless, they recovered all of the vector candles in the visible range. Now we've got another vector candle region that they're looking to recover, which is between this price point right here. Green vector candle right there on the daily between 56,867, and then we've got 54,496. This, for me, is a sweet spot for Bitcoin. All right. It's a very interesting sweet spot. And if we're going to look at it from the perspective of, if we're going to look at it from a technical point of view, some traders will be looking at this thinking that this is an area of support, which you would be in your rights to say that that would be the case. Because the logic is that when price comes back into this zone, we're going to assume the idea of price reversing from that. We'll look at this from a different perspective. Rather than focusing on this whole area here, we're going to focus on this green vector candle region right here. So this is a block. And what's the importance of a vector block? The vector block itself, and I'm talking just about the range of this candlestick high and the candlestick low. And this vector block suggests to us that this is an area where they are going to trigger interest, because the last time it went there, they marked prices higher from there. So that in principle is the logic, that we think that this area could be a nice area for Bitcoin to bounce. Technical analysts will come in and say there's a 200 EMA right there. Retail traders will be setting limit orders at that point. Retail traders will be getting liquidated at that point. Ultimately, everywhere you see in this chart is a reactive point, which in principle, it highlights intention, which means that at specific points in the chart, traders are going to do something. That do something is either buy or sell. If they get rocked with price and it completely drops to the downside, then they might actually start running for the shorts. That's where we could effectively see reversals in Bitcoin, because the story makes sense. They have been dropping Bitcoin down significantly. NASDAQ's been going down significantly. Where are we at with NASDAQ? Here we go. Look, NASDAQ, it's been rolling over. It hasn't actually done too bad considering. But we've got vector candle regions right here on the NASDAQ that we've got to be very careful of, which could be a point of interest. The cost of business, the cost of money is going up, ladies and gentlemen, and this is what we need to be expecting from the Fed. Goes on to say that the Federal Reserve is expected to announce on Wednesday, which will be in the next hour. Okay, well, actually, in 30 minutes' time, we're going to have the FOMC statement. Here we go. So here we go. We've got the federal funds rate, which is expected to be at 5.5. And then the FOMC statement, we're going to be looking for key comments in this statement. But quite frankly, I'm not even interested in the statement itself. I'm interested in Powell and what he has to say. Already today, we had, look, JOLTS job openings. Again, they can't seem to get it right. They projected a 8.68 and it came in at 8.49. They expected it to be higher on the PMI, and it came in at 49. So the PMI data itself is very important because the manufacturing data, because it's going to tell us where we are economically, because it's the ISM manufacturing data that's going to lead us into believing if companies or manufacturing companies are going to want to increase the cost of their goods, which will then naturally be pushed onto the consumer. And that's where inflation starts to become a problem, because as long as they can absorb the costs and employment is thriving, according to ADP non-farm employment change, then we're only going to have more interest rates or higher interest rates for a longer period of time. That only means that our lovely, pointless waste of paper, Dixie, dollar, is going to keep climbing. What do you use dollar for? You buy gold, you buy coffee, you buy orange juice, you buy wheat, you buy corn, you buy soya, you buy oxygen, you buy all sorts. You can buy XRP as well. Don't do that. But you're always going to use dollar. If we're going to do what I think they're going to do, the yields are going to shoot up. When they spike up, dollar in principle will follow suit, because it means that that's going to encourage foreign investors to say, you know what, let's pick up some dollars. All right. Now, let's just have a look at, I did some trading today. I hope you understood that logic with the trading that I did earlier on. Luckily, I managed to get rid of that trade, which was pretty scary from that high that we wanted at 506.5. Or was it 6.4? Yeah, it was in that region. So we managed to get out, and then they just swept it all the way to the downside again. I did take a couple of other trades as well. Where is it? Here we go. So I had a loss today. I gave some back. I'm going to be straight with you. I gave some back, but let me just zoom in for you. All right, so this is not today. I haven't taken 370 trades today. That's not today. This is today, okay? And I've only got a 59.19% win rate over 370 trades. And collectively on our funded accounts, we've cleared around $43,000. It's cost me 10% of that, which ain't too bad. It's a bit taxing, but nonetheless. But this loss right here, okay, I was effectively, I'll explain the loss right now, okay? This is where I was. It was this area right here at 5,046. Usually what the S&P likes to do is if it comes close down towards the lows of the profile, we expect them to try and sweep that. What they ended up doing throughout the rest, for the whole of this day, is they made the move up, they made the move down, and then they just stabilized in and around the point of control. Just look at where price is in reference to that point of control right there. Absolutely dead. And when you don't get a range or a profile of price, which means a big high or a big low, you pretty much understand where you are with the market. You don't, I was trying to take shorts from this area here, 50.47, and I ended up paying the price, man. They just kept going back into the depth of market, into the point of control, and then they brought it all the way back down again. And I was playing this game with the S&P. I was like, for God's sake. And again, my advice, you don't trade during news. Specifically speaking, as a scalper, you don't want to trade during or anticipation of news itself. The reason being is because you're not going to get that ebb and flow of price. It's just not going to be there. If you just look at what it's doing right now, it's currently at 5,054. It's not really going anywhere. It's still inside the area of what we call value. Here we go. This is exactly the same spot, but imagine it to the downside. I'm expecting it to continue to go up, right? So hypothetically, you take a long from this point. Look what it does. It just magnetizes back to the midpoint of value. Because when we go into a value area high, it means that we're looking to see higher prices. And look, they just bring it back again. So that's where you should really not even take trades during these situations, all right? Quickly looking at Bitcoin on the offering out. We've got Bitcoin on the book map. Now, book map is great for that order flow breakdown. You can see already that we have got, what? The VWAP's all the way up here, around 57,408. And they're slowly offering price out. What does that mean? Well, it means that they're slowly selling it. If you look at the top side right here, can you see this area where it says order and volume? So volume is up plus 15%. And when you start seeing this figure turn negative, who's hollering at me? When you see this figure go negative, it suggests that offers are being taken. That means they are actively selling the Bitcoin on limit. So all these orders up here, you can see 150 Bitcoin up there at 57,420 and 57,390, 171 Bitcoin. Collectively just shove around 350 Bitcoin in and around that zone. The idea is that they sweep above the VWAP to bring it back down again. All right. And Bitcoin appears to be in what would look like a rotation on the VWAP. Okay. So we're going to be paying attention to this. It looks like it wants to try and make a little bit of a move up, but nothing hype. Now, where's chat? Where we at? Let's have a look at your questions. Okay. I will not trade today. Those are exactly my words. That's what I said. And I ended up trading. It's just one of those. All right. Did Bookmap ever talk more about doing vectors? Quite frankly, I'd love to. You can see vector candles. They're imbalances. That's all they are. All right. And you can establish the imbalances by looking at the order flow. You know, if you go into this area here, all right, let's just go into the 1 hour time frame on the bids and the offers. All right, let's just zoom in for a split second. Oh, we got some offering. Here we go. Bitcoin wants to make a little bit of a move. Here we are. So if I zoom in, all right, then I don't even know if you can see that. No, man, you ain't even going to see that. Nothing whatsoever. Hey, wait a minute. What am I doing, man? Where's my EXO gang? There we are. We'll get EXO charts up for a split second. Okay. What time are we on? 25 minutes. We're still good. Okay. Just wait for EXO charts to open up. That's good. All right, then. So, questions. If you had to pick one, aluminium or XRP. Do you know what? Funny you say that. Aluminium, okay, commodities are actually, they're doing all right, man. Just look at aluminium. It's aluminium, not aluminum. Why call it aluminum? Doesn't make sense. Anyways, aluminium is not really a... What was going on? Here we go. There we are. So it's a decent, when I say decent asset, I mean, it hasn't stopped going up. It's been doing really well. It's like, this is on the 15-hour time frame. So you can tell already investors are kind of concerned because they start buying aluminium, you know? And palladium, I mean, that's getting smacked. Gold, 2,400, man. What a story. Absolute madness right there. Quickly just go back into USDT chart. Problem. The USDT chart is more of a psychological chart rather than a chart for chart thing. Okay, so what do I mean by that? It just shows me where people are buying, shows me where people are selling, but it's the reverse in principle. Okay, so you can see now USDT is going up, so they're transacting on the Bitcoin. Okay. And then Bitcoin in principle is going down, USDT is going up because the denominating factor is that they are exchanging their Bitcoin into USDT. But at the same time, what we understand is that as price is going down, the bids are coming into play. So you can look at this chart and think of retail. All right. So when this is going up, in principle, they are buying the Bitcoin. Yeah? Does that make sense? Let me know if that makes sense. You've got to really look at it like that, guys, because if you're going to consider even using things like this, you need to get into your mind the relationship between the bids and the offers. And the bids and the offers are the critical thing on the makeup of a candlestick, okay? All right, what we got? Aluminum is poor man's XRP. 2% isn't a pump, bro. I'm sure that's not to me. Okay, then. Crypto Sam. On the 5-day, they've already recovered that vector. Doesn't the 5-day... Is the daily vectors? The 5-day. Where's the 5-day? Where's my thing? Where is the thing to actually... What are you doing? Days. Just go back to Bitcoin a second. Here we are. 5-day green vector candle, all right? They've come back into the midpoint of the candlestick, which is very important. Look at that, man. Look at that, where we are right now. It's all or nothing from this. But this is the 5-day chart, all right? So there's still more room. That's what I'm saying. You can still get Bitcoin for a discount around 51K. All right. And that's what we've got to take into consideration. If you buy Bitcoin now, right? What if Powell comes out and says, that's it. You got interest rates higher. We're not going to increase interest rates until 2025. Bitcoin goes all the way down. So you've effectively missed out. And that's the thing that you're never going to know. You know, and the way you get, this is how I get rid of the idea of having to know what the future holds when it comes to trading. It's by focusing on smaller movements, in my opinion. Again, look, price is at the point of control for the S&P right now. I can either make the assumption that price is going to go up from here and try and grab 3-4 ticks, for example, okay? 3-4 ticks is more realistic for me because I then need just a little bit of information to understand the interest between buyers and sellers in this area here. So I need to start seeing this gap right here. You see that? I expect blue orders to come into that very, very shortly because in principle, it's a gap in the order flow. So I've already identified a point in the order flow to say to me that there could be some movement to the upside on the S&P, okay? And then I played the game and I'm like, okay, then there we go. So they're starting to work their way up into that. That right there improves the odds for me. All right, it hasn't completely failed it, but what I'm trying to say to you is, when you're looking for shorter moves, and I get it, in crypto, there's fees and what have you, which is why I trade the futures markets. A lot of guys in crypto swing trade, which is naturally, you don't have to worry about the fees. But when you're scalping futures markets, you don't have that problem other than commissions for round trips. So you open and close a trade, you're paying a certain amount of liquidity. For example, it costs me $63 to make $1,373 on this position. Cost me $19 to make $630. That's just the cost to open and close the trade. That's what it is. A round trip is what they like to call it. Got a little bit smacked with these fees right here because I was using different sizes, but naturally there were more trades in that area, okay? But it's cost me $4,474 to clear 43K, all right? So that's why I trade the futures markets. Cryptocurrency in terms of futures, let me show you what that is all about. The futures markets for cryptocurrency is a little bit tricky, and I'll show you why. MTM, where is it? Bitcoin. Come on, bro. What is that ticker symbol? Here we are. So these are the... Let's get the May Bitcoin futures, just to put it into perspective for you. Look at this. I've done this before, all right? Let me just get, as an example, to show you the difference between the two, okay? Then you'll understand why I don't trade it on the futures markets of the CME. So look at that. That's your offer. That's the ask. That's the bid. Now look at the S&P's bid and ask. It's very tight, okay? So let's just pull this up here and let's find an account that we can do this on. All right, then let's go with 305. All right, then cool. So this is the S&P, right? Watch this. You take a buy purchase, all right? That's how much it's costing me. All right, it's $12.50 per tick. So look at that. It's nice. I can deal with that. All right. It's a nice closed, tight spread. That works for me. Okay. Now, watch Bitcoin. So it was $12.50 for the actual lot size on the S&P, right? Watch this for Bitcoin. Won't let me. What's the standard contract size I need for that? Is it 5? No. Won't let me take the trade. Why not? Is it 10? Let me see. Don't give me no 10 standard contracts. Here we go. No, it won't let me do it. Won't let me take a trade. Won't let me open a trade. Look. Literally won't let me take a trade. Well, what I'm trying to say to you is this. If I go long on this, I have got effectively 1, 2, 3, 4, 5, 6, 7 tick loss on one contract. So if I go back into the S&P right now and place a long, 7 tick loss would be 1, 2, 3, 4, 5, 6. I'd be at $87 drawdown from the second I open the trade. Well, look now, I'm literally at evens. I can deal with that because the spread is tight. That's why I won't trade Bitcoin futures on the CME, and it's quite treacherous because there's no volume. Look at the contract size. It's dead, all right? But when you go to like Binance or Bybit, then you are effectively getting better price for. That's why they have the funding rate, just to give you that flexibility of no spread with Bitcoin. On the futures markets, there's a horrible spread between the bid and ask because it's very lightly traded, and you can get bullied on Bitcoin futures markets. You are very brave to trade Bitcoin on the futures markets on the CME. Oh, here we go. We're going to try and make a couple of quid profit. Come on. Sweep, sweep, sweep. Keep going. Yeah, we'll take that. Happy days. Never mind. All right, then. Cool. Are we cool with that, ladies and gentlemen? Yeah? Right. So, we're getting close to it, ladies and gentlemen. We've got 13 minutes until the FOMC statement comes out and the federal funds rate, and we're going to be assembling our charts to get ready for the madness that is about to unfold. Any other questions, guys? Here we go. So tired of these clickbait thumbnails from YouTube. What do you want it to say, bro? Video. Like, come on. We need people's attention. Like, this is FOMC. You know? I'm hoping, hopefully you're not talking about my thumbnail. Or does anyone complain about Netflix's titles and thumbnails? No. So why should they complain about YouTube's? Why would you be even angry about a thumbnail or a title? It doesn't make sense. There are so many worse things happening right now, but life must be good, must be very good if clickbait titles are a problem for you. So, yeah. Bitcoin is going up. Whales are buying. They must know something. They sure do know something. Let's have a look at what the whales could be doing. Let's have a look at the Coinbase Premium Index. That's something that we really want to be paying attention to. Coinbase Premium Index suggests what are they doing? Wow, they're buying. High premium values could indicate US investors' strong buying pressure in Coinbase. That was yesterday. That's buying pressure. So we can go back to the logic and assume that if Bitcoin is going to make a reversal and the principle of the bids is they are getting ready to make a nice reversal, we should have our reversal today. That's the principle. And before you guys start putting this aged well and all of that madness, why? I'm not even going to get bothered into it. Tino, is the fast move equals the false move on Bitcoin? The fast move, the false move on Bitcoin. What do we understand that means? What does it mean? Fast move is the false move, okay? So NASDAQ and S&P are quite notorious for doing this, but Bitcoin is also notorious for doing this. The fast move suggests that if price is going really fast in a specific direction, it's sinister. It stinks. And when you keep on seeing price going up and up and up, it's because they are selling the Bitcoin to passive orders. That means we go back into this again. You see these guys up here? 78, 55, 63. These guys will be planning on selling very soon. They've got contracts to sell. Now they just need the market to believe, oh my God, it's going up. They're going to be buying. Aggressive buyers are the reason why assets will mark up. But even though 78% of the transactions, even more, are programmed by algorithms, fundamentally, these algorithms are designed to move money. That money needs to come in first. And they do it at speeds of light. They've already got pools of liquidity attached to the algorithms. For example, that's what a market maker is. He has, say, a pool of $50 billion, and he's going to be providing liquidity for a specific market. That algorithm is then designed to find orders from an exchange. The exchange gives the orders as little pings. Those pings then go to the algorithm. The algorithm grabs that liquidity, matches it to its own, and then pushes it back into the marketplace. Happy days. You've got a transaction. You've got a trader that's happy as Larry. He's in a Bitcoin long to the upside. Awesome. Okay? That's exactly what goes off with a market maker. But the algorithms are the ones that will move the price. They will move because of the frequency of real market orders. Market orders move the markets. Passive orders, they're just sat there. That's not moving a market now, is it? It's just up there, 55, not doing anything. Same logic in Bitcoin. Go over here. You've got a dude up there that wants to sell 1.75 million Bitcoin at 57,420. What's he doing to the market other than just sat there like a wet fish? He ain't doing anything. He's not moving the market, but he's giving us insight into what the market could be going towards, which could encourage investors to believe if Bitcoin starts to climb up from this point, I'm going to go long. He gets his order filled. So he's planted that order there. So he may not have moved the market and he may not be doing anything to the market, but he is going to be, in principle, creating hype. He's going to give a trader a reason to buy by matching his order against him. Remember that. When you go long, someone go, okay, Something's going on. We got some flavor. We got some BTC action. Here we go. They've cleared those offers up there. They're selling. Retail's come in right now. Buy Bitcoin. What's the flavor? We ain't even into the FOMC just yet, and there's 8 minutes left. Is everyone getting excited right now? Are you excited? Let me see. There is a. This is going to be a drop like the 28K drop in the last bull run. I think the low 40s could be the bottom of this drop, but it will take a couple of months more to get there. Well, yeah, that could be the case. Look up here. Can you see that? As long as that's red, that means they're selling. That's good news. Limit buys are coming in now, which is green, which means bids. So they're loading up on some bids right now. I don't offer trade signals. It's trade setups. You know, if you're part of the Traders Reality website, then you can take advantage of trade setups. I give trade setups every single day. It's 5 setups in principle, which is Euro, Bitcoin, Ethereum, Solana, gold, oil, NASDAQ. That's 7. Have I missed any? I go through those assets every single day because, in my opinion, those are the assets that move the markets and represent the bigger picture. Okay. So that's Platinum membership. It's pinned to the top of the chat if you want to check that out. Okay. If you guys think the move is up, the move up is because insiders know, and this is the move, I would advise caution. Let's just look at the bigger picture for a second before we consider something. What's Bitcoin been doing for the past 2 days? It's been taking a shoe bag to the downside. 2 sessions, Asia drop, US drop, Asia drop, US stalls. Funnily enough, going into the FOMC, right? Even if Bitcoin pumps up, that would be deemed as your fast move. But it's what it does afterwards. The faster they move Bitcoin back up, the more concerned I am about it. I would need to see Bitcoin make the clear move up to make the retrace back down and stabilize in this area. And then I will be like, okay, FOMC is done. We know they're holding the interest rates. It's going to cost more to do money. People are going to lose faith in fiat. We should see Bitcoin climb back up. And it will be that area right there. What would I need to see here? I'd need to see these dudes mark price up and bids to come in this area here, the 57 zone. So sweep up, come back down, maybe give or take, move it up a little bit more to then associate the idea of the rise, the retrace, continuation from this point. If you're not looking at it from that perspective, right, then you're just going to be sat drawing lines on a chart with no real context behind it. The hybrid system gives you the context by the means of vector candles. So I can assume they're going to come back into these vector candles over here at 59 purely off the volatility of Bitcoin and the FOMC. I can associate that. But I've been looking at these charts for a long bloody time, and I've seen this pattern repeat itself over and over again. I look at the chart and say, maybe this could be the case, that they're going to try and do it from this point. All right? I'm not looking for Bitcoin. Tino, is Bitcoin going to go from 57,000 to 192,000? Right. It doesn't work for me. There's no point. People will say, yeah, Bitcoin will go to 150K. Yeah, it probably will. When, bro? I don't know. I know it's going to go. What do you know? Well, there's a 21 million. Shut up. What do you know? You don't. And then when Bitcoin gets to 150K, it's like, told ya. Everybody wants to know the when. All right? Because they don't know the when, that's what makes this game mysterious. It's the game, it's the realm of uncertainty. You are in the arena of uncertainty, ladies and gentlemen. That's the truth. Now, let's just get things set up for a second, because we are now going into FOMC statement. And then after this, I'm going to take some more questions. We'll have a look at some altcoins just to put things into perspective, which will give us about 30 minutes before the press conference. And then we're going to listen to Powell talk and divert questions regarding the statement of the FOMC, which is coming out in the next 2 minutes. You just bought XRP. I don't even know whether I should say I'm sorry or if I should give you your money back. You just bought 100K XRP. What do you want me to say to you, bro? Congratulations on buying a stable coin. Mike says to me yesterday, you really did talk XRP down. There are people that hold quite a substantial amount of XRP, and you're there screaming and cussing about it. And I'm like, I'm one of those people. I hold XRP. I can say what I want to say about it. Give me a reason why I shouldn't. Tino's secret crushes XRP. You're mad. My date with XRP, I was blindfolded. That's what it was. It was a blind date. It was, I'll just buy this coin. What is it? XRP. Ripple. Oh, could be a sign. The ripples of life. It could be a good thing. Anyways, here we go. Ladies and gentlemen, the statement will be revealed and the actual federal funds rate. Do you know what? Could you imagine if they actually made a mistake and it came in at 5.75? Oh my days. That happened, and they changed the policy, sorry. That happened with the US dollar and the Swiss franc. That was crazy. 400 pip drop. My days. Here we go. Big order just came in there. Wow. Look at that. 650. Just got pulled. It just got pulled. Wow, they pulled that order. That was a nice little dud order. Here we go. All right, it's now. Here we are. Press conference, the statement, sorry. Federal funds rate. This should put things into perspective. Here we go. What's S&P doing? Look at S&P. Look what S&P's doing. S&P's making movements. Bitcoin's making movement. Could be good news on the statement. I don't know just yet. But they're selling. And back into value. See, this is just an initial reaction, but nothing to be too concerned about. Bitcoin ain't doing much, but S&P, look at that madness right there. Bitcoin bids are coming in quite aggressively. If you just look there, keep an eye on that. Bitcoin ain't going nowhere. I don't believe this thing. S&P's trying to climb up. Let's just have a look at the NASDAQ for a second. NASDAQ is pumping up nicely right there. Look at that. It's moving up very nicely. Load this up. All right, so this is the tick chart. We'll wait for that. All right, and so there's the NASDAQ right there, moving pretty fast. Daily high, daily open is coming into play right now. So if anything, they're probably marking prices higher to offer out, which could then decide on where we could end up going. Look at this. This is why you don't trade this madness. Look at it. Look at it. It doesn't look much, guys, on this chart here, but just look at it from the depth of market point of view. 5, 6 tick gap wipes. Like, it's up and down. Look at that. Like, these ladders is just unbelievable. Here we're at Bitcoin. Come on. Come on. S&P's going down. This is important because if S&P goes down, then it's likely Bitcoin's going to go down. That's the logic. Okay? So what can we see about the statement? Let's just put that over there for a second. What are they saying about the statement? Because S&P's taking a shoe bag. Issues that. Okay, recent indicators suggest economic activity has continued to expand at a solid pace. Job gains have remained strong. The unemployment rate has remained low. Inflation has eased over the past year, but remains. This is the same thing. As described in its previously announced plan, beginning in June, the committee will slow the pace of decline of its security holdings by reducing the monthly redemption cap on Treasury securities from 60 billion to 25 billion. The committee will maintain the monthly redemption cap on agency debt and agency mortgage-backed securities at $35 billion and will reinvest any principal payments in excess of this cap into treasury securities. Where are my bonds? Where's my yields? Yields. Sharp. Look at that. Spiked to 5%, comes straight back down. What did we say about this? This goes down, everything goes up. That's the logic. 10-year, where we at? Down. That's good news. Bonds, they're buying it. A happy days. Shooting up. That's good news. Treasuries, where we at with the treasuries? Here we go. Look at that. Treasury futures, T-note bills. Happy days. Dollar dominance. Chow chow. Oil. Not really doing it for me. Gold. Yippee-ki-yay. Euro. Happy days. Bitcoin. Coming away from the range daily low. That's good news, guys. Very good news. Where is it? Where is my book map? Let's have a look. All right, so we got offers, minus 29%. That's good news. That is good news. They're selling the Bitcoin. Remember that. They're selling now. They've been buying it. Now they look to selling it. And we've got some orders over here that could be something that they transact on, okay? They loading the algo. FOMC rate on hold as expected. Yep, no rate cut until gained greater confidence regarding inflation progress. Look, tell me something new. Now big banks are going to start rolling into gold. They're going to be buying up the gold because they just need to effectively cover themselves. That's what they're doing, which quite frankly, equity hedge investors have already been buying the gold on the retrace down. They're only going to be selling into the banks that are buying it right now. Here we go. Here we go. Offers right there. Look at that. You see that? Perfect. Offers are coming in. So 16%. I need that to stay above 30%. Happy days. They're starting to sell. 153 Bitcoin. They're eating it. They're eating it. Vector candle. Come on. Clear that range, BTC. Give me the flavor. Give me the flavor. Keep going. Oh, nice absorption there. Okay, so they've pulled back on that. 236 Bitcoin purchased at that point. So now what's going on? All the short sellers are getting liquidated, trying to rush for cover. Damn, my short's getting compromised. Quickly, close it, which in principle is now going to encourage traders to start going long, which is where we can expect a nice little snapback coming to a theater near you. What do we mean by that? We'll just pay attention to what goes off in the next few seconds. If they are going to snap on retail and retail's jumping in on the bandwagon to go long from this, we really need to see them clear this point right here on Bitcoin, which, in my opinion, they need to break above 58,285 to sustain the idea of a continuation up, okay? They need to clear that. Otherwise, if they've caught traders' interest right now on the idea of them going long, then they're going to try and liquidate those traders, bring it back down to try and come back up again. There she goes. There she is, away from the VWAP. I'll be so surprised if they bring it all the way back down again. That would be taxing, to say the least. You see the psychology of what goes on. Oh, my God, Bitcoin's moving up. And then they don't clear a range, and now they're just pulling it back, making those traders who are buying right now pay the price. Sad, but true. Metallica. Anyways. Go, me. High leverage, long stop loss in profit for now. Let's go. Well done, my bro. Sat in McDonald's watching it pan out whilst my Big Mac goes cold. Is that a big W formation? Yes, sir. That is a big W formation. Huge W formation on the 5-minute time frame. So it's nothing really great to get excited about. But you can see here that we do have a structure, a psychological structure, which would suggest that bids are coming in, they're loading up, they offer out, load up again, they offer out, and then they're going to load up again on the second instance, which hypothetically would be retrace, continuation to the upside. That is logically what we would expect, okay, from Bitcoin. So now we know where we stand with the marketplace, okay? Yields are down. Bitcoin is up now, ish. S&P, where are you at? Whoa. After all that. Yeah, they're still waiting for Powell. No real movement there. If you just have a look at exo charts for a second for my guys who do exo charts. Yeah, look, there's no real movement here, guys. Nothing whatsoever. That makes sense. They're only just waiting for Powell to have a conversation. We just have a look at Bitcoin's profile in terms of the volume. So here we go. This is for my guys who are trading order flow, for anyone that is interested in it, this is the one-day profile, and Bitcoin is just about to get above the value area high, which sits at 58,018. All right? We have chump change all the way. Oh, okay. All right, so 60K could be an interesting point for Bitcoin because we've got this imbalance zone right here. This imbalance where there's very few contracts in this area, all right? Where we at? All right, so if Bitcoin is now marking up, let's have a look at Ethereum. Without failure. Without fail. 3,000 Ethereum. 5-minute time frame. And again, look, this is... If you can take advantage of these sort of plays, get in, get out, you know, happy days. You don't need to be a swing trader to just capitalize on that. Of course, swing traders take advantage of bigger moves, more money over a period of time, but there could be more heartache with that as well. Let's just have a look at... You've got to be kidding me, bro. Ladies and gentlemen, we've made it to 51 cents. Just makes me want to buy more. I'll wait till it gets back to 50. That way I can guarantee I'm getting a good feel. Stupid coin. Solana. That's a coin, man. Tricky coin. But that's a coin. Moves very well. Back into the EMAs. Got to see them clear this range over here. We have to see them clear 130. But just be careful with FOMC press conference. Retrace continuation out. You've got to be careful with that. Jasmy token. Starting to make a move to the upside, quickly going into the yen itself. Look at that. It's only consistent with the belief that there could be an intervention. They're starting to hold out. Remember, yen goes up, dollar goes down, Bitcoin goes up, euro goes up, gold goes up, anything against the US dollar goes up. The yen would be one of the key factors to dollar going up or down. Hopefully this was intervention. Hopefully. All right. Quickly going to S&P again. Yeah, nothing. No interest there. Tesla, gap up. Okay, no problem with that. Quickly go back into Bitcoin. Still giving us that decent move up. We haven't, yeah, so see that there where they drop, retrace back up? That's good news for me. Okay, but it's still struggling with this area here, which is a bit of a cause for concern for me. Right. There's a reason XRP is cheap. Well, yeah, I know there's a reason why. Do you know what? That is true, man. You know, William J. O'Neill puts it into perspective. He says there's a reason why stocks are cheap. Stocks that are like $10 and $5. You really want to be aiming for stocks that are priced above 25 because they're also going to have the market cap behind it. Okay, so look at this. Arcadia, Healthcare, $74. ACLS, kind of an LX. Axelis, 101, Enact Holdings, 29, American Financial Group, 129, and Aflac, $84. They always end up being the ones that are doing well, okay? So you don't really see cheap stocks doing really great, unless they're penny stocks, but they're only going to be good for 5 minutes, okay? All right. Questions. Watching this madness unfold in my OG red hat TR hat that I won. Saj. We got one of the winners here. One day I'll have enough money to buy a membership. Man. Isn't there a lockup on Jasmy that's supposed to happen? Maybe. I haven't dived into any of the details of Jasmy. But, it's going to be interesting to see how Powell rolls out with this. We've got 20 minutes until Powell actually has the conversation. Let's just go and have a look at what Bloomberg are starting to say about this. Fed seeks more signs that inflation's pace will slow. Seeks more signs. Let's just read this. My guy. Here we go. So these are the key elements too. As Chris has highlighted, the biggest news so far is the decision to slow their tapering. Okay, then. Basically, everything in the FOMC statement came in as expected. That's correct. With the exception of quantitative tapering, a bit more than anticipated. It's all about the press conference as the statement reads more or less as expected. The Fed is admitting they are worried about inflation and they are not ready to cut rates. That much was broadly known. This is true. But the big question now is what Powell signals about when the Fed might have confidence to cut or if he leaves open the door to another hike. Do you understand, ladies and gentlemen? If they increase it one more time, we're going to have problems. Because quite frankly, if they do decide to increase the interest rates again, do you understand how damning that is for the Fed? Because they kind of like got it wrong. You know, they thought 5.5% would be enough. It doesn't look like it, quite frankly. It does not look like it's enough. You know, how many of you? All right. So how many of you with mortgages? How much has your mortgage payment gone up by? Okay. If you're in the US, that is. How much of an impact has that had? Okay. Now imagine hundreds of mega market cap US companies that have got the same problem in terms of loans that they've used to buy or invest in the specific aspect of the business. Those loans now could potentially be increased. Those payments are going to be higher, and they're going to be higher for longer. That only leads the company to do one thing: cut the workforce, because that's what the Fed wants. Go back into this. Okay? Where is it? Here we go. The Fed is worried about inflation, and they're not ready to cut rates. That's broadly known. When will they have the confidence to cut it? That there, to me, tells me that I think a surprise interest rate increase could be on the cards, ladies and gentlemen. That's what I think. And quite honestly, that will break the market, in my opinion. That will force the recession. That will bring the sharpest correction known to man. And then that will be a huge discount across the board. You understand how cheap things will be? Because value right now is already locked into the NASDAQ and the S&P. When I say value, I'm talking about on the daily time frame. Just look at it from this perspective. Value is in the S&P and NASDAQ. Just look at that. The price increase just alone off the NASDAQ itself has shot up nearly 75%. So principally, as this is a measure, a metric of the collective of tech stocks, 74% increase in the NASDAQ. It's like lots of stocks have increased to the same figure in principle. All right. You want to challenge that? Just go and have a look at, let's have a look at Meta. Okay. Look at Meta on the monthly. Not bad, bro. Not bad. Okay. Look at Nvidia. Where are we at? Nvidia, there we go. Look at that. This thing doesn't stop. And my projection for $1,000 is, I'm waiting for it. 980, we hit it. 1st of May. 1st of January. You know? 3 months ago. Nearly hit it. 980. Not bad. You know? But $1,000 easily. Easily. So where does that leave us with Bitcoin? It's one of them ones. All right then, ladies and gentlemen, 1:15. What else have we got? We're going to be getting into Jerome Powell's speech very, very shortly, ladies and gentlemen. And listen, if you are new to this channel, my name is Tino. Welcome to Traders Reality. It is a mad reality, to say the least. We sit and talk about Bitcoin, the NASDAQ, the S&P, gold, euro. We make all sorts of fun and noise about it. All right? But fundamentally, this channel is going to help you understand the relationship of how, in principle, the market works. Or the better way for me to put it, to give you a better chance at understanding uncertainty. That's what this channel is all about. So if you are satisfied with that criterion, make sure you like the button that is likable and subscribe because it's subscribable. And we're going to be going into Powell very shortly. Where are we at with the likes are 700, man. Like, come on. 3,352. That is crazy. But there's not enough likes. That's the currency. That is principally, that's your TR token. The like button is your TR token, you know? Hit the like button. We'll be getting into that flavor of Powell very, very shortly. I'm just waiting for you to start asking some cool questions. Here we go. Tino, what's the best scalping strategy using the hybrid system? I trade gold and euro. Can you have a look and show me, pretty please? Marco, it is a pleasure to show you. If you are new to Forex, now this is something that people might challenge me on, but Euro is a very heavily manipulated asset, okay? But the cool thing about euro is you can marry that up to the dollar dominance because euro makes up 56% of the dollar dominance, okay? Now, the dollar dominance is made up of a basket of assets. You've got the euro, the pound, the yen, the Swiss krone, and I've forgotten what the other one is. The Swiss, it's something, it's Canadian dollar, okay? But the main assets you want to focus on are euro and the yen, okay? Because the euro makes up 56%, the yen makes up 17%, and the pound makes up 9%, okay? As time passes, naturally, those percentages will increase, decrease, but euro will always be the dominating factor, okay? And when you use euro, when you scalp euro, pay attention to the dollar dominance. That helps, okay? You can also pay attention to dollar yen. I traded dollar yen for 6 years straight. I didn't look at nothing else. Nothing else, just dollar yen. I learned dollar yen inside out, and yet I'm still learning about dollar yen. But the one thing that I can tell you about the dollar yen is when you pay attention to the yen itself and you pay attention to the policies that Japan are doing and understand what impact it has on the dollar, remember, the lower the yen, the higher the dollar goes. The lower the yen, the better it is for them in terms of trade, okay? The higher the yen goes, the worse it is for them. And that's where we are right now with the yen. They're having to step in to avoid their currency from collapse because it's just going down. It's gone beyond parity. Like, parity is a big thing. Like, let's just go, look, I mean, yeah, where it originally started from. Look at that. It's gone beyond the parity point. My days. It's going lower. That's bad news, man. So they really need to do something about that. But in my opinion, euro and gold, I mean, gold itself is a tricky asset to play. The one thing you need to understand about gold is simple. When it goes down, they are protecting themselves. They are buying gold. And when it's going up, everyone's jumping on the bandwagon for gold being a safe haven. When you start seeing gold as a safe haven, you're too late because they're jumping in, they're selling into the people that are buying gold right now because they want it to be a safe haven. Okay? So that's really important to understand. All right? Tino, ES is doing nothing. I know ES is doing nothing. That's why I wouldn't trade it now. I would not do anything. Bitcoin's come all the way back down again, triggered those guys to go long and made them pay the price. Here we go. T, studying the vector in its simple form. The midpoint of the green vector on the daily on the 26th of Feb, 53,125. Will it tag this, or is there a time frame where it's too far gone? The best way for you to navigate vectors, because that's 53K. That's, in my opinion, that's too far away for me. That's too far away when you look at it from the 1 hour time frame. So if you trade on the 1 hour time frame, 53K could be a little bit too far away for me as a scalper, right? If you're looking for a midterm, let's look at it like this. And listen, if you are new to this channel, the Traders Reality website has a free course on the hybrid system. I recommend you take it, okay? And right there, take this course because things that I'm going to talk about right now are taught to you in this free course right here. Once you've done this free course and you have an element of confidence, take the scalping course. That's a paid one, and that's Exo Charts. That's a paid one, okay? But it's the cheapest in the industry. But the information, from what I've been told, is next level. I'll tell you exactly how to do it in each of these courses, all right? And I cut the time down to 4 hours, all right? So there's lots. There's about 5 hours worth of just trading videos on the Exo Charts one. And there's about 25-minute trading video on this one with Bitcoin, okay? How to scalp Bitcoin. Right? But do this one first. Take the breaking down the hybrid system. That's free. That's going to give you everything that you need to understand about what we're going to talk about right now. And it'll give us enough time to go into Powell's conversation. So when you're looking to trade vector candles, this is a vector candle right here. And let me just remove this so you guys can see it clearly, right? These lines, all these lines will make sense to you when you take that course. You've got to become a bronze member, which is free. Then it gives you access to it. But look, these lines right here, the vector candles all represent points in the chart that locally or close by, I can expect price to do something around. So I've got to look at this range and say, okay, maybe Bitcoin could move from this point. I've got a vector candle right here. Let me take the midpoint and have a look at how price reacts to that zone. Well, 2 instances, they've tried to move back into the midpoint of the vector. What's the midpoint of the vector? It's pretty simple logic. It tells me that as price started to come down and it became a vector candle, because it wasn't a red vector before, it was a gray candle, then it became a red vector because price started to sell off, okay? I would associate that at that midpoint, that's where the selling started to pick up, but that is the opposite. Remember, this red candle tells me they're buying, okay? And when I see price stabilize in these areas here, that's where I start paying attention and start looking at the scope and say, what vector candles are close by for me to trade towards? So the first one would be this one. The second one would be this one up here. The third one, even though it has been recovered, it's still a point where historically, if they are going to mark prices lower from there and go long and bid down, I would expect this area here to be a resistance point. So that's what you've got to do with the vectors. You've got to marry up this story up and say to yourself, right, where can the market repeat history? Because I know it's going to repeat history. That goes without saying. I know it's going to repeat history, okay? So just take that into consideration when you are trading with the vector candles, all right? They are the opposite of what you see price doing. Red vector candle drop to the downside. People are going short. You're preparing to go long. Okay? Notice the tone of 3. 1, 2, and 3. Logic says we expect a move back up. That's the principle. And that's the environment we've got. We've got moving averages. Happy days. And if it doesn't work, it doesn't work. Welcome to trading. But it's a form of structure when you go into the charts. Okay? Dan, welcome to the hodlers. Tina, how are you trading for so long and still have so much hair? I'm 3 years in and I'm only on my 2nd trip to Turkey. That is funny. That is really funny. All right then. That is hilarious. Okay then, guys, let's get ready for it. We're going to get ready for Powell. 5 minutes. So you've got 5 minutes to get yourself a nice little cup of coffee. Okay? We're now going to prepare the chart. So we've got bookmap over here. I'm going to bring up bookmap. And what we're going to be paying attention to with bookmap right now is the offers. This happened last time. Last time was different though, because Bitcoin was at the highs already. We're now at the lows. Okay? So if we start seeing the offers appearing at the top side up here, whilst Powell is speaking, there could be a potential for price to try and go up towards them. But the last time we saw that, it went towards it, never followed through, and Bitcoin ripped. So we just got to take that into consideration and be very careful with it. Okay? Do you think Bitcoin's going to crash to 40K? I don't know why people think it can crash to 40K. Because we already know the information. We know that they're keeping the interest rates on hold. We know that inflation is a bit of a problem for them. And if Powell does turn around and say, if Powell turns around and says hard landing, well, 40K ain't going to be a problem. That's my opinion. Nasdaq and S&P are climbing up. Nasdaq and S&P are moving up. Let's see. Yep. ES is moving up. 5,070. That's good news. Okay, then. So we're getting involved right now, guys. Here we go. We're going to have Powell over here. Bitcoin price in the middle right there. We're going to have bookmap over here. And we are going to wait and see if it works in our favor. Here we go. All right, then. I'm going to get this party started off. Are we ready? We need the rainbow. My days, it is going absolutely crazy right now. You got to see what's going on over here. This is the NASDAQ. NASDAQ is going bat. It is going absolutely crazy. Still not on yet. Bitcoin's coming up to that red vector candle. That'll be good news for us. All right, then. Now, listen, this is the how I'm going to do this, all right? Whilst Powell is speaking, we're going to be trying to listen out for, man, that's weird. We're going to try and listen out for if he gives us any idea of a hard landing. I'm hoping someone asks that question. The idea of a potential cut in the future, all right? Because the statement itself doesn't really bring anything, okay? Does anybody know if it's on the YouTube channel? It should be getting ready to go right now. Let me see. Yes, continue. Let me just put this here. Here we go. No. There we are. All right, then. So this is where Powell is. This is what we're going to be hearing from Powell. Can you guys clearly see? I'm hoping you can see. All right, get ready for it, ladies and gentlemen. This is the moment of truth. What are you doing, bro? All right, then. Price in the middle. Get ready for it. 5 coughs from Powell, yeah? All right, put your bets in right now. I think he's going to cough 6 times. 6 times. We have a little bit of a laugh and a joke, but I am going to be listening to what Powell is going to be saying because this is going to dictate the likelihood of the cost of money. The cost of printing is what we should really call it. Get rid of that. Okay. Come on. Get with it. Come on. Okay, then. Now we're not going to look at that. We're going to have a look at the depth of market on the S&P. That's going to be important for me. Just going to look at that over there, the bottom right. Just paying attention to S&P's price. Here we go, ladies and gentlemen. Time to tune in. Let's roll with the flavor. Okay. Oh, there she is. That's Gina from Financial Times. No, not Gina. No, that's Gina from Financial Times. She's dyed her hair. Wow. Not bad. There's that dude over there. CNN, is it? Or CNBC? Here's the boy. Here we go, Mr. Jerome Powell. Let's get the party started off, guys. Here we go. Oops. Hold on.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially over the past year, while the labor market has remained strong. And that's very good news.
Sorry,
but
guys.
Inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings, though at a slower pace. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings that are consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Howard Schneider with Reuters. A question to follow up, if I could. Do you consider the current policy rate still, are you confident that it's sufficiently restrictive to get inflation back to 2%?
So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular, but it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw it, more evidence of that today in the JOLTS report, as you'll know. It's still higher than pre-pandemic, but it has been coming down both in the Indeed report and in the JOLTS report. That's demand cooling. The same is true of quits and hiring rates, which have essentially normalized. I also look at we look at surveys of workers and, surveys of workers and businesses and ask workers, are jobs plentiful, and ask businesses, are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those activities. So I do think it's clear that that policy is restrictive.
Sufficiently restrictive, I guess. Is the word.
So I would say that we believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that that the data will have to answer.
So
the
as a
guy a
follow-up,
drink.
if inflation
Pardon me.
continues running roughly sideways as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for
Expectations are not anchored.
or anchored,
Or anchored.
stable, roughly? Would you disrupt that for the last half point on PCE?
That was
I don't
tough.
want to get into complicated hypotheticals, but I would say that we're committed to retaining our current restrictive stance of policy for as long as is appropriate, and we'll do that.
Gina. Oh, it's Tina or Gina.
Thanks for taking our questions, Chair Powell. I wonder, obviously, Michelle Bowman has been saying that there is a risk
Gina.
that rates may need to increase further, although it's not her baseline outlook. I wonder if you see that as a risk as well, and
not her.
if so, what change in conditions would merit considering raising rates at this point?
So I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely.
That's good news.
Our policy focus is really what I just mentioned, which is how long to keep policy restrictive. You ask, what would it take? I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at the totality of the data, answer to that question. That would include inflation expectations, and all the other data too.
Would that be like a reacceleration in inflation?
Well, I think, again, the test, what I'm saying is if we were to come to that conclusion that policy weren't tight enough to achieve that, so it would be the totality of all the things we'd be looking at. It could be expectations, it could be a combination of things, but if we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
Chris.
Thank you, Chris Rugaber at Associated Press. You didn't mention the idea that rates are at a peak for the cycle, and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So has the Fed sort of dropped its easing bias? Where are you standing on that?
Offers
So
coming in.
Let me address cuts. So obviously, our
Listen
decisions
in.
that we make on our policy rate are going to depend on the incoming data, how the outlook is evolving, and the balance of risks, as always. And we'll look at the totality of the data. So I think, and we think, that policy is well positioned to address different paths that the economy might take. And we've said that we don't think it would be appropriate to dial back our restrictive policy stance until we've gained greater confidence that inflation is moving down sustainably toward 2%. So, for example, let me take a path. If we did have a path where inflation proves more persistent than expected and where the labor market remains strong, but inflation is moving sideways and we're not gaining greater confidence, well, that would be a case in which it could be appropriate to hold off on rate cuts. I think there's also other paths that the economy could take which would cause us to want to consider rate cuts. And those would be, two of those paths would be that we do gain greater confidence, as we've said, that inflation is moving sustainably down to 2%. And another path could be, an unexpected weakening in the labor market, for example. So those are paths in which you could see us cutting rates. So I think it really will depend on the data. In terms of peak rate, I think really it's the same question. I think the data will have to answer that question for us.
Well, and could you just follow on the path where you might not cut? Is that, you mentioned that it would be inflation persistent. Is inflation, would that be the key data in making that decision, or could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we'd want to be confident that inflation is moving sustainably down to 2%. And for sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly incoming inflation data would be at the very heart of that decision.
Nick.
Nick Timrose of the Wall Street Journal. Chair Powell, to what extent has the easing in financial conditions since November contributed to the reacceleration in growth? And do you now expect a period of sustained tighter financial conditions will be needed to resume the sort of disinflation the economy saw last year?
So I think it's hard to know that. I think we'll be able to look back, from down the road and look back and understand it better. If you look at, let's look at growth. Really, what we've seen so far this year in the first quarter is growth coming in about consistent with where it was last year. I know GDP came in lower, but you don't see an acceleration in growth. I mean, the thought would be that financial conditions loosened in December, and that caused an uptick in activity, and that caused inflation. Presumably that's or tightening in the labor market. You don't really see that happening. What you see is economic activity at a level that's roughly the same as last year. So, what's causing this inflation, we'll have a better sense of that over time. I don't know that there's an obvious connection there, though, with the easing of financial conditions. In terms of tightening, you're right. I mean, rates are certainly higher now and have been for some time than they were before the December meeting, and they're higher, and that's tighter financial conditions, and that's appropriate given what inflation has done in the first quarter.
You've said in the past that stronger growth wouldn't necessarily preclude rate cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
So I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year: very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic-related supply side distortions and demand side distortions, and there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can't continue. I wouldn't give up at this point on further things happening on the supply side, either because, we do see that that companies still report that there are supply side issues that they're facing. And also, even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either either growth or a strong labor market in and of itself would automatically create problems on inflation, because of course it didn't do that last year. You ask about wages. We also don't target wages. We target price inflation. It is one of the inputs. The point with wages is, of course, we like everyone else like to see high wages, but we also want to see them not eaten up by high inflation. And that's really what we're trying to do, is to cool the economy and work with what's happening on the supply side to bring the economy back to 2% inflation. And part of that will probably be having wage increases move down incrementally toward levels that are more sustainable.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You talked about needing time to gain more confidence that inflation is sustainably moving back down to 2%. It's May now. Do you have time this year to cut 3 times, just given the calendar?
Yeah, I'm not really thinking of it that way. What we said is that we need to be more confident, and we've said, my colleagues and I today said, that we didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of conference. So I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope, and I don't know exactly when that will be.
And with hindsight, are there any
Last
signs that you can
question.
look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
Man, that's a long pause.
Not really. What
What a guy.
So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. And so take a step back. What do we now see in the first quarter? We see strong economic activity. We see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should take some signal. We don't like to react to 1 or 2 months' data, but this is a full quarter. And I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path down to 2% inflation. That's the signal that we're taking.
Steve.
Yeah, Mr. Chairman, if I could, Steve Leisman, CNBC, if I could follow up on that. What particular areas were sort of temporary or blips in the inflation data in the first quarter? And what's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah. So we will, we will put the thing, we have put the thing under a microscope. I will say nothing is going to come out of that that's going to change the view, I think, that in fact we didn't gain confidence and that it's going to take longer to get that confidence. But confidence, I just think, you know the story. What's happened since December is you've seen higher goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had thought. And there are stories behind how that happened, and I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. So we're looking at those things. We also continue to expect, and I continue to expect, that housing services inflation, given where market rents are, those will show up in measured housing services inflation over time. We believe that it will. It looks like that there are substantial lags between when lower market rates turned up and for new tenants, and when it shows up for existing tenants or for in-housing services. So,
If I could just follow up, is there a bit of a contradiction in the idea that you are reducing quantitative tightening, which is sort of an easing, while you're holding rates steady at a restrictive rate to try to slow and cool the economy and inflation? Thank you.
I wouldn't say that, no. I mean, the active tool of monetary policy is, of course, interest rates. And this is a plan we've long had in place to slow, really not in order to, to provide accommodation to the economy, but to be less restrictive to the economy. It really is to ensure that the process of shrinking the balance sheet down to where we want to get it is a smooth one and doesn't wind up with financial market turmoil the way it did the last time we did this, and the only other time we've ever done this.
Craig.
Craig Forrest from Bloomberg. Two questions. First, simple one. Given the run of data since March, has the probability in your mind of no cuts this year increased or stayed the same? That's the first question. Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like. Lawyers, accountants, all kinds of highly qualified people who couldn't get jobs. And given your history there, I wonder if there's an argument for being more patient with inflation here. We have strong productivity growth. That's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria about inflation. I agree, it's, nobody likes it, but is there an argument for being patient and working with the economic cycle to get it down over time? Thank you.
So on your first question, I don't have a probability estimate for you, but all I can say is that, we've said that we didn't think it would be appropriate to cut until we were more confident that inflation was moving sustainably on at 2%. We didn't get, our confidence in that didn't increase in the first quarter, and in fact, what really happened was we came to the view that it will take longer to get that confidence. And I think I think it's, the economy has been very hard for forecasters broadly to predict its path, but there are paths to not cutting, and there are paths to cutting. It's really going to depend on the data. In terms of the employment mandate, to your point, if you go back a couple of years, our sort of framework document says that when you look at the two mandate goals, and if one of them's further away from goal than the other, then you focus on that one. It's the time to get back there times the times how far it is from the goal, and that was clearly inflation. So our focus was very much on inflation.
Come on.
And this is what we referred to in the statement. As inflation has come down now to below 3% on a 12-month basis, it's become we're now focusing the other goal, the employment goal, now comes back in to focus, and so we are focusing on it. And that's how we think about that.
Claire.
Claire Jones, Financial Times. Thanks a lot for the opportunity to ask the questions. Just to go back to the answer before the previous one, it seemed to suggest that you think the likeliest path of inflation is one that's going to allow you to have a situation where rates are lower at the end of the year than they are right now. It'd be good if you could just confirm whether or not that's a correct reading. And the Q1 GDP print has led to some to start mentioning the term stagflation with respect to the US economy. Do you or anyone else on the FOMC think this is now a risk? Thank you.
Yeah, I'm not dealing really in likelihoods. I think there are paths that the economy can take that would involve cuts, and there are paths that wouldn't. And I don't have great confidence in which of those paths. I think I would say my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be sufficient. I don't know that it won't. I think we're going to have to let the data lead us on that. In terms of your second question was stagflation. I guess I would say I was around for stagflation, and it was 10% unemployment. It was high single digits inflation right now we have, and very slow growth. So right now we have 3% growth, which is, pretty solid growth, I would say, by any measure. And we have inflation running under 3%. So I don't really understand where that's coming from. And in addition, I would say, most forecasters, including our forecasting, was that that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%, and that won't be. So I don't see the stag or the inflation, actually.
I just tried to scalp from that situation.
The vice chair
Very
of
tricky.
the FOMC said recently that he's willing to consider the idea that potential growth has moved up, and of course he's Mr. Potential Growth, our star. Do you share that view, and would that imply that maybe policy isn't tight enough?
So I think I would take that question this way. We saw a year of very high productivity growth in 2023. And we saw a year of, I think, negative productivity growth in 2022. So I think it's hard to draw from the data. The question is, will productivity run? There are two questions. One is, will productivity run, persistently above its longer run trend? I don't think we know that. In terms of potential output, though, if that's a separate question. We've had what amounts to a significant increase in the potential output of the economy that's not about productivity. It was about having more labor, frankly, both through, in 2023, both through participation and also through immigration. So we're very much like other forecasters and economists getting our arms around what that means for potential output this year and next year and last year, for that matter, too. So I think in that case, I think you really do have a significant increase in potential output. But you've also got, so you've got more supply, but those people also come in, they work, they have jobs, they spend. So you've also got demand. So it may be that you get more supply than you get demand at the beginning, but ultimately it should be neither inflationary nor disinflationary over a longer period.
Well, you said earlier that at this point you're not really considering rate increases. If growth is higher, but you're not considering rate increases, does that imply that you're more worried about causing the economy to slow too much than you are about inflation taking off again?
No, I think we believe our policy stance is in a good place and is appropriate to the current situation. We believe it's restrictive, and our evidence for that I went over earlier. You see it in the labor market, you see it in inflation-sensitive spending, where demand has clearly come down a lot over the past few years, and that's more from monetary policy, whereas the supply side things that are happening are more on the supply side. So that's how I would think about it.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. So GDP growth is about 2%. Inflation, employment is about 4%. It feels a lot like a steady state, and we have 3% inflation. So if the data remains the same that you're seeing, and I know you said you don't see a rate hike, but it stands to reason that you would need a rate hike to get from 3 to 2% inflation. So was there any discussion about a rate hike in today's meeting? And are you satisfied with 3% inflation for the rest of the year?
Well, of course, we're not satisfied with 3% inflation. 3% can't be in a sentence with satisfied. So we will return inflation to 2% over time, but over time. And we think our policy stance is appropriate to do that. So if we were to conclude that policy is not sufficiently restrictive to bring inflation sustainably down to 2%, then that would be what it would take for us to want to increase rates. We don't see that. We don't see evidence for that. So that's where we are.
Was there a discussion about a rate hike at all?
So the policy focus has really been on what to do about holding the current the current level of restriction. That's really that's part of the policy. That's where the policy discussion was in the meeting.
Yeah, I wanted to follow on the 3%. Is there a time frame of persistent inflation that would trigger a rate hike?
There isn't any rule. You can't look to a rule. These are going to be judgment calls. Clearly, restrictive monetary policy needs more time to do its job. That is pretty clear based on what we're seeing. How long that will take and how patient we should be, it's going to depend on the totality of the data, how the outlook evolves.
Victoria.
Hi, Victoria Guido with Politico. You've talked about your commitment to being apolitical and nonpartisan, and I was just wondering, given that it's an election year, is the bar for rate changes higher close to an election? And similarly, is there a significant economic difference between starting to cut in, say, September versus December?
So we're always going to do what we think the right thing for the economy is when we come to that consensus view that it's the right thing to do for the economy. That's our record. That's what we do. We're not looking at anything else. It's hard enough to get the economics right here. These are difficult things, and if we were to take on a whole nother set of factors and use that as a new filter, it would reduce the likelihood we'd actually get the economics right. So that's how we think about it around here. And we're at peace over it. We know that we'll do what we think is the right thing when we think it's the right thing, and we'll all do that. And that's how everybody around here thinks. So I can't say it enough that we just don't go down that road. If you go down that road, where do you stop? And we're not on that road. We're on the road where we're serving all the American people and making our decisions based on the data and how those data affect the outlook and the balance of risks.
And then is there a significant difference between, whether you start in, say, September versus December?
There's a significant difference between an institution that takes into account all sorts of political events and one that doesn't. That's where the significant difference is, and we just don't do that. I mean, you can go back and read the transcripts for every. This is my fourth presidential election here. Read all the transcripts and see if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. If we start down that road, I don't know how you stop. So
I thought he was going to start pulling out his fingers. What a guy.
Thank you, Chair Powell. Question about the labor market. You've mentioned a few times that the labor market is normalizing. Certainly today's JOLTS data suggested that things are kind of getting back to pre-pandemic levels. One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic. I wonder if you can share your analysis of why that's happening. Is it a lagging indicator or something else going on?
So I think if you go back to where wages peaked, wage increases peaked a couple, 3 years ago, essentially all wage measures have come down substantially to that. But they are not down to where they were before the pandemic. They're still roughly a percentage point higher. And we've seen pretty consistent progress, but not uniformly. And you'll note the ECI reading from Tuesday was expected to have come down, and essentially it was flat year over year, I think, roughly. So, yeah, I mean, that part of it is bumpy. And again, we don't target wage increases, but in the longer run, if you have wage increases running higher than productivity would warrant, and then there will be inflationary pressures. Employers will raise prices over time if that's the case. So we've seen progress. It has been inconsistent, but we have seen a substantial decline overall. But we have ways to go on that.
Scott. You were Nancy. Nancy. Sorry.
Who's Nancy?
Hey, Chair Powell, Nancy Marshall-Genzer from Marketplace. You mentioned consumers, and consumers are feeling the weight of interest rates right now. Mortgage rates are up, as are rates for car loans, credit cards. People looking to borrow are very discouraged. That's reflected in their views on the economy. What would you say to them?
Good question.
Well, the thing that hurts everybody, and particularly people in the lower income brackets, is inflation. If you're a person who's living paycheck to paycheck, and suddenly all the things you buy, the fundamentals of life go up in price, you are in trouble right away. And so with those people in mind in particular, what we're doing is we're using our tools to bring down inflation. It will take some time, but we will succeed, and we will bring inflation back down to 2%, and then people won't have to worry about it again.
Oh,
That's what
thanks.
we're doing, and we know that it's painful and inconvenient, but the dividends will be paid will be very large, and everyone will share in those dividends. And we've made quite a lot of progress if you can think about it. I think headline core PCE peaked at 5.8. Now it's at, anyway, headline peaked at 7.1. Now it's at 2.7.
He's rattled.
Don't want to get that wrong.
No, you don't. Quick follow-up. Are current interest rates really doing that much, though, to fight inflation right now for those consumers?
Yes, I mean, I think that restrictive monetary policy is doing what it's supposed to do, but it's also in this case unusually working alongside and with the healing of the supply side. That was different this time was that a big part of the source of the inflation and the reason why we're having this conversation is that we had this supply side kind of collapse with shortages and bottlenecks and all that kind of thing. And this was to do with the shutting down and reopening of the economy and other things that really raised demand. So many factors did that. So I think now you see those two things working together, the reversal of those supply and demand distortions from the pandemic and the response to it, along with restrictive monetary policy. Those two things are working to bring down inflation, and we've made a lot of progress. Let's remember how far we've come. And we have a ways to go. We've got work left to do, but we're not looking at the very high inflation rates that we were seeing 2 years ago.
Courtney Brown from Axios. Thanks for taking our questions, Chair Powell. I wanted to follow up on something you mentioned earlier on housing inflation. There's kind of been this long-awaited disinflation in shelter that still hasn't arrived. So I guess two questions. How do you explain the substantial lags between some of the private sector data we're seeing and the government data? And how confident are you that rents will be helpful on the inflation front in the coming months?
It's a wild question.
Essentially, there are a number of places in the economy where there are just lag structures built into the inflation process, and housing is one of them. So when you have when someone a new person goes to rent an apartment, that's called market rent, and you can see market rents are barely going up at all. The inflation in those has been very low. But it takes, before that, they were incredibly high. They sort of led the high part. So what happens is those market rents take years, actually, to get all the way into rents for tenants who are rolling over their leases. Landlords don't tend to charge as much of an increase to a rollover tenant for whatever reason. And what that does is it builds up a sort of an unrealized portion of increases when there have been big increases. And what happens is, it's complicated, but the story is it just takes some time for that to get in. Now, I am confident that as long as market rents remain low, this is going to show up in measured inflation, assuming that market rents do remain low. What will be the exact timing of it? I think we've learned that the lags are longer. We now think significantly longer than we thought at the beginning. And so confident that it will come, but not so confident in the timing of it. But yes, I expect that this will happen.
Thanks.
Nick Jasinski.
Thank you, Chair Powell, for taking the questions. This is Nicholas Jasinski from Barron's Magazine.
Okay, here we go.
It seems that over the past 3 or 4 years, economies and central banks in developed markets at least have been on more or less the same trajectory, easing during the pandemic, fighting inflation with restrictive policy on the way out. Feels like that may be ending in 2024 based on some of the economic data from Europe and the US and Japan and statements from those central banks as well. So my question is, what considerations or risks does a period of more divergent global economic trajectories and central bank policies present for the FOMC?
So you're right. I think that may happen, and you know that we all serve domestic mandates, right? So I think the difference between the United States and other countries that are now considering rate cuts is that they're just not having the kind of growth we're having. Their inflation is performing about like ours or maybe a little better, but they're not experiencing the kind of growth we're experiencing. So we actually have the luxury of having strong growth and a strong labor market, very low unemployment, high job creation, and all of that. And we can be patient, and we will be careful and cautious as we approach the decision to cut rates, whereas I think other jurisdictions may go before that. In terms of the implications, I think obviously markets see it coming. It's priced in now, and so I think the markets and economies can adapt to it. And I think we haven't seen, in addition for the emerging market economies, we haven't seen the kind of turmoil that was more frequent 20 years ago, 30 years ago. And that's, I think, partly because emerging market countries, many of them have much better monetary policy frameworks, much more credibility on inflation. And so they're navigating this pretty well this time.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You sort of backed away from the notion that the economy would need to encounter pain for inflation to come back
She's
down.
new.
But given sticky inflation data in the first quarter, can disinflation still happen along a relatively painless path for the economy, or is some softening in the labor market and the economy likely needed to bring inflation back down?
So you're right. I think we thought, and most people thought there would have to be probably significant dislocations somewhere in the economy, perhaps the labor market, to get inflation all the way down from the very high levels it was at the beginning of this episode. That didn't happen. That's a tremendous result. We're very, of course, gratified and pleased that hasn't happened. And if you look at the dynamics that enabled that, it really was that so much of the gain was from the unwinding of things that weren't to do with monetary policy, but the unwinding of the distortions to the economy, supply side problems, and also some demand issues as well. The unwinding of those really helped inflation come down. Now, as I've said, I'm not giving up on that. So I think it is possible that those forces will still work to help us bring inflation down. We can't be guaranteed that that's true, though. And so we're trying to use our tools in a way that keeps the labor market strong and the economy strong, but also helps bring inflation back down to 2% sustainably.
Stop
we will
saying
bring
that,
inflation
man.
down to 2% sustainably. We hope we can do it without significant dislocations in the labor market or elsewhere.
And speaking of dislocations in the labor market, in terms of cutting, you said if there were weakness in the job market, that could be a reason to cut rates. So if the unemployment rate were to tick above 4%, but inflation not back down to your 2% target, how would you look at that? Would the unemployment rate popping back above 4% catch your attention?
I said an unexpected weakening is the way I characterize it. So, and I'm not going to try to define exactly what I mean by that, but it'd have to be meaningful and get our attention and lead us to think that the labor market was really significantly weakening for us to want to react to it. A couple of tenths in the unemployment rate would probably not do that, but it would be a broader thing that would suggest that it would be appropriate to consider cutting. And I think whether you decide to cut will depend on all the facts and circumstances, not just that one.
Chair Powell, thanks for taking the question. Kyle Campbell with American Banker. You've said that broad and material changes are needed for the Basel III endgame proposal.
What's his name?
You've
Napoleon
mentioned that
Dynamite.
A reproposal is something that's on the table. As you've had more time to sort of sit with the public commentary, process that, and understand the options available to you, do you have a better sense of whether a reproposal will be necessary? And do you have a timeline in mind for when some sort of movement will be made on that front, either a reproposal or a move to finalize?
If he can get there, I can get there.
Let me start by saying that the Fed is committed to, completing this process and
what a guy.
Carrying out Basel III endgame in a way that's faithful to Basel and also comparable to what the other large comparable jurisdictions are doing. We haven't made any decisions on policy or on process at all. Nothing. No decisions have been made. I'll say again, though, if we conclude that reproposal is appropriate, we won't hesitate to insist on that.
And then do you need to resolve issues with the capital proposal in order to advance other parts of the regulatory agenda, or do you expect to continue to make progress on those other agenda items?
There's no mechanical rule in place there, but I would say that the Basel III process is by far the most important thing, and really is, I think, occupying us at this time in terms of what we're moving ahead with.
Napoleon Dynamite did well. Happy with that. What a guy. Who's this?
Thank you, Mark Hamrick with Bankrate. Mr. Chairman, what can you tell us about the approach that you take with your role in the sense of trying to achieve consensus, which you recently identified as a priority, while allowing for a range of views or even dissent? We don't see many dissenting votes in the official statements, even when more spirited discussions are noted in the minutes after the fact. How do you avoid groupthink and avoid a higher risk of a policy mistake? Thank you.
So I think if you listen to, and you all do, listen to my 18 colleagues on the Fomc, you'll see that we do not lack for a diversity of voices and perspectives. We really don't. Right. And it's one of the great aspects of the Federal Reserve System. We have 12 reserve banks around the country where they have their own economic staff, not the people who work here at the board. They're different people, and so each reserve bank has its own culture around monetary policy and its own approach and that kind of thing. It guarantees you a diversity of perspectives. So I think that the perspectives are very diverse, but and in terms of dissents, we have dissents, and a thoughtful dissent.
What's with the
is
shrugging?
a good thing. If someone really makes you think, that kind of thing. But all I can say from my standpoint is I listen carefully to people. I try to incorporate their thinking, or do everything I can to incorporate their thinking into what we're doing. And I think many people, if they feel that's happening, that for most people, most of the time, that'll be enough. But I'm not. It's not frowned upon or illegal or against the rules or anything like that. It just is the way things come out. And I think we have a very diverse group around the people, frankly more diverse than it used to be in many dimensions, more diverse from the obvious gender and demographic ways. But also we have more people who are not PhD economists. So we have people from business and law and academia and things like that. So I think you actually do have quite a good diverse perspective. I think all of us read these stories about a lack of diversity, and we look around the room and say, I don't understand. I really don't understand what they're talking about. So, but I get the question, though. Thank you very much.
All right, see you later, bro. Nice. All right, ladies and gentlemen. So, look, the whole mandate story, I've been trying to play this whole thing. I'm running shorts right now on the S&P. And I'm looking for NASDAQ to just take a shoe bag to the downside, which is exactly what I want it to do. Happy days. It's going down. And we have now, here we go. So I was actually long on the S&P whilst he was talking. It can just go against me as it always does. But this is the tricky thing about it. I'm looking for it to go back down just to eat that liquidity. He's done talking. He's done running his mouth. Now everything should be coming back down. I think I should actually get rid of this and just narrowly. I'm just waiting for NASDAQ to just continue with the move lower. But it's the choppy behavior is what's starting to wind me up, because it can go straight back up again and then it'll come back down. But I'm just waiting to see if they're going to really do the flavor. They're done with it. We know where we are. We know 2%. You're boring. You've held the interest rates. You've coughed 60 times. You've not really given us anything to really be concerned about. Bitcoin spiked up. We did pretty well in terms of a setup today with Bitcoin as right there. So our setup seemed to have worked out well for Bitcoin and Ethereum and Solana. That's on the Platinum membership for anybody that is interested in that stuff. But I just need to pull that back in. Hold on. Where is my... where we at? Okay, so yeah, you know what? I'm getting out of that, man. I'll take that. I don't care. I'm trading the wrong time anyway, but it's a quick scalp and it can just continue to go down. I haven't got the patience to, if it doesn't go down straight away, I'm out. So we did all right with that little trade right there. Happy days. Not bad. So, with that being said, let's just go and have a look at what's going on across the board. So, Euro, yippee-ki-yay, up to only come back down again. Not bad. XRP, fair play to you, my bro. Still not buying any more of you. Solana's made the move up. That's good news. But Ethereum, I mean, our setups have worked today. So if anybody took advantage of that, well done to you. But if we go and have a look at what the bigger picture is, what they're talking about, a rise in unemployment would have to be meaningful for us to react. A couple of tenths of an increase. Now, if unemployment rate were to shoot up, and let's just make the assumption here, they're expecting it to be 3.8. If that goes down, we've got problems. Then all of what we've just heard Powell say is just going to be pointless. He's hoping that the actual the unemployment rate does go down with the impact of inflation going up and the high interest rates, but it's very unlikely that's going to be the case. Inflation's still going to be sticky, ladies and gentlemen. That's the truth. Anyways, ladies and gentlemen, I hope you've enjoyed yourselves. If you are new to the channel, make sure you like and subscribe on the way out. Likes are 1,400. Mad love to you. I hope you've enjoyed tonight. But now we can trade in peace. We don't have no FOMC to be worrying about. So, ladies and gentlemen, mad love to everyone that stayed here tonight. Take care of yourselves, and I'll be checking in with you all tomorrow morning. Take care of yourselves, gang. Peace.